Welcome back to our channel. This is Heidi Henderson with Engineered Tax Services. And today we're going to do a deep dive on active versus passive activity, which I think are the real rules of cost segregation. The question this whole episode answers is your cost segregation deduction actually going to offset your income? Now, a lot of people ask me the question repeatedly, I don't know if cost segregation is applicable or if my property qualifies for cost segregation. What's interesting is it's not whether your property qualifies, because we can apply cost segregation to any type of investment real estate. The question is actually, if I own investment real estate, if I use cost seg to create this large deduction, can I qualify as a taxpayer, as an individual? Can I qualify to use the deductions against my ordinary income or my W-2 income? That's really the bigger question, and the question that really investors and taxpayers should be asking. The engineering side of cost segregation gets all of the attention. We talk and educate a lot on how cost segregation works, the importance of understanding what you're paying for before you actually engage a firm, to understand engineering-based cost seg and the details, and understanding what the IRS looks for in their audit technique guidelines and defining cost segregation. However, the tax side actually determines whether you actually save anything once you do the cost seg. And so most investors and many CPAs, they don't think about that until it's too late. With us at Engineered Tax Services, our ultimate goal is to make sure that that's all understood before you engage us. I would never want to complete a cost segregation study for you and then have you come back later and say, hey, we just filed the tax return. I had a $125,000 deduction or loss from the real estate due to the cost seg, but yet I didn't save anything on my taxes. And that's never a good situation for us because we desperately want to create cash value, a cash benefit through the tax savings that you generate through these types of studies. This episode or this video is specifically for you if, number one, you own income-producing real estate. Number two, you're thinking about acquiring income-producing real estate. If you have a W-2 job and you want to use cost segregation to help offset that. And then you own or you are considering a short-term rental property. Also, if you're a CPA whose clients are asking these questions, I think this video will be helpful. 6 things that we're going to cover. Number one, the study itself is not the deduction, and why a cost segregation study alone really doesn't save you anything. The number two is then the 750-hour trap, the real estate professional status, and really who it catches and how you overcome that threshold. Number 3 is the subsection 469 election. This is actually the grouping election. This gets a little complex, but can be very meaningful. And I think a lot of taxpayers and CPAs should be aware of it. And then number 4, the short-term rental loophole, which is when we've got short-term rentals, understanding the other options for material participation or activity on that, either 500 hours or 100 hours to qualify. And then number 5, how do we actually track the activity? That's the question that we're constantly faced with. And number 6, 2 case walkthroughs. I've got a couple of real-world scenarios, a physician and then a retired investor, 2 totally different outcomes for how this benefits and how it applies to both of them. First off, let's frame that cost segregation itself is not the deduction. Cost segregation creates a large loss, but cost segregation coupled with material participation ultimately creates the deduction that offsets the income on your tax return. Now, I'm assuming that we're looking at active income, W-2 or salaried income that is earned income. And so cost segregation plus the material participation is where we achieve that ultimate value with being able to deduct it. With these labels, what they actually mean. So let's define this. Non-passive, ultimately, or otherwise known as active, it offsets everything. If you have W-2 wages, bonus income, dividends, capital gains, that active loss or deduction, aka depreciation that can write off any of that other active or earned income. Passive only offsets passive income. Passive income is rental income or other passive income that you're generating through investments. It does not offset your business income, dividends, capital gains, or W-2. That's really important. Rental activity is default passive. The IRS says by default, it is passive activity, passive income, passive loss under Section 469. You have to earn your way into that non-passive situation, otherwise known as active. There are 3 ways in which you do that. Number 1, you can do that through the real estate professional status with material participation on each property. This is really important. Rep status applies on a property-by-property basis, unless you use the grouping election under Section 469. You actually group all of the properties. Then it's 750 hours for the group of properties. Number 2, you'll see on my slides, that is an orange box, the short-term rental loophole. That is only properties with an average stay of 7 days or less, plus material participation. No real estate professional status is required. This is a big one for W-2 earners, and I'll explain the details in a second. Number 3, the $25,000 offset. Active participation is capped at $25,000. However, it does phase out if you're a really high income earner. So that doesn't help most of our listeners. It can help some people. So even if it's passive, you still can utilize about a $25,000 offset. But again, that phases out at a certain income level. First one, test one, the real estate professional status. So we also call this rep status. Rep status requires 750 hours a year of services in real estate property trades per year. Now, it's actually 750 hours plus more than 50% of your time, more than half of your time. And what counts? This could be development, operation of the rental, construction, management, the acquisition process itself, leasing, conversions, brokerages, rentals. Only your hours count. This is really important. When we have 2 spouses married filing jointly, one person has to qualify and you don't combine the spouse's hours. I had a client this week who was asking me, well, my wife and I do it together, so can we just track all of our hours and we'll combine it? And I said, unfortunately, no, it's based specifically on one person. So one spouse needs to qualify in order to meet that rule. Now, if you do meet the 750 hours and more than 50% of your time, then that is allowing you to apply that loss to your W-2 income for both parties. The key is married, filing jointly on the same tax return, we're able to take those losses and apply all of that against all of the income on the tax return if you meet the real estate professional rules. So it's 750 hours plus more than half of your working time. Now, real estate will beat all of your other work. It has to, including your W-2 job. For a full-time professional, it's almost impossible. If you've got 2,000 hours a year and you're working your W-2 job full-time, that is essentially 71% of your time. And then you do 800 hours a year in real estate, that's now 29% of your time. So that fails the real estate professional requirements because 29% versus 71. You can look at the hours spent during both. It has to be 750 and more than half of your time. This is an audit trigger with the IRS. If you have, let's see, a single taxpayer filing single who has a high income W-2 job and checks the box on the return saying or claiming real estate professional status, and then is claiming the real estate is active, there's likely going to be an audit. That's not to say that you cannot qualify. I have clients that actually do qualify. They have a W-2 job, they have other income, but they still qualify as a real estate professional. I've seen that. I have seen that actually be upheld in the case of audit. However, documentation is everything. And so we'll talk about that in this video as well. The positive side of really who can qualify, Full-time real estate professionals. So people who are agents or brokers, developers, or property managers who are really all day long, they're primarily working in real estate. We see a lot of large portfolio investors. So they're managing personal rentals. They don't have another full-time job. The third one is retired professionals. So people who have transitioned into managing real estate. So it may be that you were passive, you were buying real estate while you were working, and then you've retired and you continue to hold and manage your properties. And then the fourth, you'll see my orange box, one spouse, part of a couple, married filing jointly. The non-W-2 spouse now qualifies. The qualifying spouse rule carries those losses and applies against all of the income on the tax return. So you just need one of those two people to meet the rules for real estate professional status. One thing I want to throw in here on this slide is that cost segregation can be applied at any time, even retroactively. Now, there's not necessarily a limitation, but I will say, if you're depreciating a rental property over 27 years and you've owned it for 20, you've taken almost all the depreciation anyway. So there's not going to be as much benefit. But if you've owned it for 5 or 6 or 7 or 8 years, and in that case here of a retired professional, maybe you were passive, working a full-time W-2 job, buying real estate, then you retired and now you're managing the real estate, you could do cost segregation now. You use the cost segregation now as active, and it's going to offset all of your retirement income. If you're pulling Social Security or out of your 401k, then those losses can offset all of that. If you're meeting that real estate professional status and using the cost seg in the tax year where it makes the most sense based on your activity. So that's really important. I think an opportunity that many investors are not aware of, and they're really kind of miss with that opportunity. The things that are counting towards material participation are really important because not all hours are created equal. We have items that count. The things that count are tenant time, so dealing with leasing and disputes and support, contractor time and supervising rehabs, doing inspections and walking through the properties, things that you are personally conducting, financial reviews, lenders, insurance calls, time on property, on your property that you actually acquired. All of those things where you are actively working and managing that property. Things that do not count are things like investor education, podcasts, books, webinars, mastermind groups, conferences you attend to learn and to become more savvy and doing due diligence for buying assets. Researching properties that you did not buy. That time is excluded from the qualifying hours. Passive investing in someone else's syndication, that's a really important one. So you may actually go out and invest with a syndicated fund as a passive investor, and that will not qualify as qualifying hours. You are purely passive in that investment. And then commuting time as well. If you're commuting to your rental property, those are excluded hours. The most missed procedural move when we look at properties is the grouping election for the CPAs out there at Section 469. This treats all of your rentals as a single activity for the sake of material participation. And so that way you qualify across the whole portfolio and not property by property. This is an important segue into both the real estate professional status as well as the short-term rental loophole. Both of those situations look at qualifying hours on a per property basis. You have to prove that you are working and managing each of the properties and you spent more time on each of the properties than anyone else. It is not a cumulative time. A real estate professional status is a little bit different. However, with both of them, if you pool the hours or you group those investments into this grouping election, that allows you to combine that activity. It's definitely something you want to talk with a tax attorney about or your CPA. There can be some difficulties with unraveling the grouping election if or when you sell a property. So you'll be aware that there's a little bit of legal structuring that needs to happen with that. So important to be aware of, but can be very valuable with claiming that real estate professional status. Now diving into the short-term rental loophole, again, this is like the number one biggest strategy that we see for offsetting high income, high tax dollar investors. And that is the short-term rental loophole by understanding what the conditions are and using that even if you have a high W-2 income. And that is buying a property that has an average days of 7 days or less. So it is proven that it is actually utilized as a short-term rental property, and that you have material participation. So you materially participate in the short-term rental activity. If both of those are met, you don't have to meet the real estate professional status. So rep status, 750 hours, more than 50% of your time. The short-term rental, that is not the case. The short-term rental has two options in which you can qualify that are a bit easier than the 750-hour rule under rep. The two rules that really make it matter is, number one, either you meet a 500-hour test, you work more than 500 hours on the short-term rental this year. It doesn't matter what anybody else does. So that's roughly 10 hours a week, and you've got a cumulative 500 hours for that property. The bigger one that we see the vast majority of our clients pursuing is the 100-hour rule, which is that it's 100 hours per rule, but more than anyone else. So no one worked more on the property than you did. This is the test that most W-2 earners and taxpayers right now are most commonly using or really working to achieve so that they can offset the income tax being paid through their W-2 job. The things that need to be considered: bookings, guest support, cleanings, minor repairs, marketing, pricing, all of that counts. The catch: a full service property manager working more hours than you takes it off the table. It's not to say that you cannot have a property manager. I have a few clients that have property managers, and they still spend more time because they've been doing remodeling or setting it up, and handling some of those things. But I would say that's probably the exception versus the rule. It's ideal really to be managing it yourself and then have more hours than anyone, including cleaners or contractors that are working on that particular property. The other catch that people don't talk about is that material participation resets every year. You could be qualified as a real estate professional or under the short-term rental loophole. Let's say for 2024, you manage it, you clear the 500 or 100-hour test, and then the cost seg fully offsets your W-2 income. You have this huge tax benefit. Number 20, then you move into the 2025 tax year and you're not qualified. So let's say February 2025, you're burned out. You hire a full-time manager. Your hours drop below that threshold of material participation, and now they go passive. Now it's passive activity. It's not going to offset your W-2 income. So you want to plan every year before you hire a manager, before you acquire property. Understand how that plays out on a year-by-year basis. Now, it is interesting because I've seen a number of tax strategists who are helping investors buy short-term rental properties, get them set up, do the renovations, get them furnished, have everything set up to manage on all the platforms, and start renting, typically before mid-December of that particular tax year. The cost seg is performed. The depreciation is then applied to the tax year, so let's call it 2026. We buy a property in 2026. In June, we spend 4 months doing some renovations, getting it cleaned up, getting it furnished and set up for rent. We put it on the market in, let's say, before Thanksgiving, and you start renting it in November and December so that for the 2026 tax year, you can do cost seg. You take this large deduction, it offsets your income. You get it up and running, and then January, you say, you know what? I'm going to actually have this transferred over to a property manager now, and I'll have them manage this property. Then everything going forward is earmarked as passive. However, what you claimed for 2026 was all active. We have seen a strategy where a lot of investors will buy that property in the tax year, move it over to property management year 2, buy another property and get it set up in year 2, and continue to do that every year as they build a portfolio. So very interesting strategy. And certainly we've seen it work very well for a lot of our clients. The most important thing is that every claim needs what we call contemporaneous log. To make it easier, is please document everything. What will be disallowed is working on the property for 6 hours, or property management for 4 hours. Round numbers, generic descriptions, reconstructed backlogs of generic timeframes that you say that you did things. The IRS, if you get audited, will say, show me your logs, your time logs, show me the activity, show me that you have proof that you actively managed this asset. What you do want, and what does hold up under audit, is that you have notes, you have a calendar. There are some great apps out these days that are tracking those hours. I called a plumber, the water heater, property A, I spent 45 minutes dealing with a bid to replace that. Or I walked the property with the tenant this day. Here was the appointment. It spent 90 minutes doing that. Have the date, the activity, the time, the specific description, and then timestamp it if possible. Use an Excel spreadsheet if you want. Use a notebook if you want. Whatever it is, there's no requirement by the IRS of what that looks like, but there is a requirement that you prove that if you get audited, again, I'll say only if you get audited, that you would need to actually show proof that you had that activity and you did qualify under those rules. We have a few strategic partnerships, just as some examples. Make It Deductible is one. It is an app that we've partnered with a gentleman who's actually a CPA from a Big Four firm. He has created a website, an app, and a texting platform where you can text in your activity, and then it's added to a log for time tracking. Fantastic platform. It's not the cheapest thing in the world, but very meaningful and certainly would protect you in the case of audit if you're tracking your hours. So that's one of them that you might consider. Now, a couple of case studies. I want to give you a couple of direct examples of how this works in practice before we wrap up. Case one. This is a physician. They buy a $2 million multifamily property. The W-2 is an anesthesiologist making $600,000 a year. He buys a $2 million multifamily professionally managed asset, and he wants to do cost seg to offset his W-2 income. Now, in reality, he fails the REPS test. His W-2 is more than half of his time. There's no short-term rental because the stays are longer than 7 days. The $500,000 deduction that's generated from doing cost segregation sits on his books as a passive carry-forward loss. Now, that passive loss will offset the rental income from that property. So he's not going to pay tax on that. It may offset some other investment income if he's got other investment income on the return. It will not offset the W-2 income. Now, the alternative is for him to acquire a short-term rental, meet the 500 or 100-hour test, and then do the cost seg there. And those losses then are non-passive and they would offset all of the W-2 income directly. Case two, this is a little bit different. This is a taxpayer. Now they are retired, so they have zero W-2 income, although they're pulling some 401k income and some Social Security. The real estate investor owns 8 properties, self-managed, and wants to offset the portfolio income with the losses from real estate. He qualifies as a real estate professional easily. The grouping election was filed the year that he retired, so all of those assets are rolled together. He can pool the hours. He's got a log using Make It Deductible to track all of his hours and capture material participation. So then he's got a $3 million total basis. So between all of his 8 properties, the basis or cost for all of those combined was $3 million. The year one deduction with the cost segregation, catch-up deduction on the current tax return was $900,000. So that's offsetting all of the rental income and much of his retirement income that he's pulling. Every piece in place, rep status, the election, the logs, the engineering. If you miss this one, the deduction changes and it gets disallowed or you can't use it. But the way that this is structured is laid out perfectly to offset the income in that situation. And because they're managing those assets, they can claim that in those. 3 next steps and suggestions for what you as a taxpayer can do. Number 1, we just actually finished a live webinar with Baseline, which is a wonderful platform for tracking the bookkeeping for your assets, for tracking the banking, bookkeeping expenses, and time logs for participation. That's another wonderful strategic partner of ours that we have links to. Number 2, we can do a free property analysis. Very quickly, we can look at your properties, estimate the comparison of current depreciation versus the increase or larger deduction generated by the cost segregation study, including the cost for studies. So we charge a fixed fee price, very upfront, very transparent. And then number 3, you can use Make It Deductible or some app to track hours for material participation and make sure that you have what's needed to defend your position from a tax filing standpoint and take the benefit of using massive deductions through cost segregation. If you have questions, you can reach out to me directly or reach out to our team anytime. I'm Heidi Henderson with Engineered Tax Services, and we would love to work with you.